Hi everyone, I am F. Difference Panjaitan, Accounting 23. We will discuss an important topic in advanced financial accounting, namely reporting intercompany ownership. Intercompany ownership reporting, Indonesian SAK material narration. In the modern business world, companies no longer stand alone. Many parent companies own shares or even control other companies, called subsidiaries, associates, or joint ventures. This relationship creates a need to understand how intercompany investments should be reported in the financial statements properly. This reporting is not only important to accurately reflect the financial position, but also to avoid misleading presentations due to internal transactions that occur within a business group. In Indonesia, this type of reporting is regulated in several standards, especially SAK 15, Investments in Associates and Joint Ventures, SAK 65, Consolidated Financial Statements, and SAK 71, Financial Instruments. One type of ownership and influence on reporting. The first step in determining how the financial statements are prepared is to classify the type of ownership relationship. There are three main categories based on the level of influence or control. A. Ownership without significant influence, less than 20%. When a company owns less than 20% of the common shares of another company, and does not have the power to influence the operational and financial policies of the entity, then the investment is considered an ordinary financial investment. In this case, the accounting treatment follows SAK 71, namely using the cost or fair value method depending on the classification of the investment, for example, fair value through profit or loss or through other comprehensive income. Income from this investment is only recognized when dividends are declared by the invested company. B. Ownership with significant influence, 20%, 50%. If the company owns 20% or more of the common shares, or is able to provide significant influence, for example having a seat on the board of directors or active participation in strategic policies, then the equity method is used as regulated in SAK 15. Here, the investor recognizes a proportional share of the net profit or loss of the investee. For example, if PT Induk owns 30% of PT Asosiasi's shares and PT Asosiasi records a profit of Rp 1 billion, then PT Induk records Rp 300 million as part of the profit from its investment. Dividends received from an investee are not recognized as income, but rather reduce the value of the investment. The carrying amount of the investment is updated each period to reflect the investor's share of the profit or loss, less any dividends received. In the event of significant and persistent losses, consolidation aims to present the group's financial statements as one economic entity. This process does not simply add up the accounts of each entity, but involves eliminating balances and transactions between entities within the group so that there is no double depiction of income, assets, or equity. Elimination of intragroup accounts and transactions. Some types of transactions and balances that must be eliminated include: intercompany sales and purchases. If the parent company sells goods to the subsidiary company for Rp 200 million, then both the sales revenue at the parent company and the purchase expenses at the subsidiary must be eliminated from the consolidated report. Unrealized profit. If the goods have not been sold to a third party by the subsidiary company, then the profit from the internal